Hello and welcome to this Monday's weekly market briefing. We've got lots to talk about, but firstly, companies ease back on their company shares buybacks as rising interest rates increase costs. Along with that, Turkey proposes an opposing, India Middle East trade corridor plan in opposition to the current one, as I said. Along with that, public confidence in the Bank of England reaches all-time lows. Along with that, ECB hawks a warning of another potential rate rise in December, in contrast to what we heard last week. And finally, there is Chinese optimism, or at least optimism with the Chinese economy finally, following some new data released on Friday, but we'll come to that nearer the end. As well as that, we've got lots to talk about on the charts, lots of opportunities to do with the dollar and the indices. And finally, we've got lots of data to come to in relation to the UK's interest rate decision, along with the Bank of Japan's interest rate decision, along with lots of inflation data. So stay till then. But let's get straight into it. So the first thing to talk about, obviously, is the companies easing off on buybacks as rising interest rates push up costs. Now, although companies buying back their own shares is quite a controversial kind of thing for them to do, it's been very pivotal in causing share prices to become inflated. Share buybacks, on the US stock market have dropped to the slowest pace since early stages of the COVID-19 pandemic. Now, this is a result of rising interest rates undermining the incentive for companies to purchase their own shares. Companies in the S&P 500 spent $175 billion buying back shares in the last 3 months to June, with this being a 20% decline from the same quarter last year. This has sparked worries that the slowdown marks a beginning of a longer term trend, which can put some downward pressure on the stock market. Now, since we started to see more optimism with inflation and some more optimistic rhetoric from the Fed, we've actually seen a climb in the US indices from their lows when there was great fears of a US recession. And so we've kind of seen that growth within the stock market. However, along with that, there's been great growth in relation to that, because of these company buybacks, where they buy their own shares and as a result increase the demand for their own stock, and as a result drive prices higher for their stock. Now, buybacks, as I said, generally prop up share prices, adding to demand and help improve profitability on an earning per share basis by reducing the number of shares in circulation. Thus, a fall in corporate buybacks will cause the demand for the stock to deflate, as a result causing downward pressure on the stock. And so, although we might be seeing some, positive reactions more recently, or at least in the last few months, in relation to new inflation data, in relation to stocks, we might actually start to see a decline within these stock markets, just as a result of companies reducing their buybacks of their own stocks. Now, the increase in the new investment demands and higher borrowing costs have led to these buybacks being less of a priority. And this is because when rates were zero, it made sense for firms to issue long-dated, low-rate debt and use it to buy back shares, as a result inflating their share price. However, now pressure to invest in areas such as reshoring supply chains, automation, and artificial intelligence, which has grown this year, and reaching net zero targets as well, leaves little capital for share buybacks. Now, worries of new regulations have also meant that companies are preferring to protect their dividends over buybacks, and this is kind of positive with a lot of the European investors, which often argue that companies should return capital dividends rather than doing buybacks. But ultimately, this will put major pressure onto US indices, which we'll come to at the end on the chart, so you're able to see how this is actually going to affect the S&P 500, the US 30, and the Nasdaq. But we'll come to that near the end. But the second article to talk about really is this. and that is being Turkey floating an alternative to the G20's India Middle East Trade Corridor plan. Now, Turkey's in intensive negotiations, with regional partners over its alternative to the India Middle East Trade Corridor plan that was agreed at this month's G20 summit. Now, we know that the G20 had a summit in New Delhi recently, and there's great opportunities were found with India in relation to a lot of these leading countries in relation to trade and how they might improve that. We talked about that to do with Rishi Sunak as well as Biden, and the improving relations between those two countries and India. Now, this comes as Turkey attempts to bolster its historic role as a transport route for moving goods from Asia to Europe, and we know Turkey's a long-term, not a long-term, but a historic, partner in this kind of industry of moving trade through its country, and we know that from the Silk Road. And so it seems like Turkey's trying to get in and make itself known in that sort of area once again. Now, the original route proposed didn't include Turkey, but instead included the UAE, Saudi Arabia, Jordan, and Israel with the European markets. So, as a result, it's obviously a deal which is primarily going to benefit the European Union as well as India, but also these newer, or at least newer, growing kind of nations such as Saudi Arabia, the UAE, Jordan, that rely largely on their oil production. And so it's kind of interesting to see how they're trying to diverse away from that, and try and go more into the the trade industry. But the proposal that was proposed by those countries, including Israel, was backed by the US and the EU in an attempt to repel China from its growing influence. And we know this from last week when we spoke about a lot of these nations like the US are trying to diversify their supply chains away from China, not only in relation to their their increasing economic troubles in China, but as well as the foreign policy issues which are mounting, especially in relation to Taiwan, which may become an even bigger issue in the future. Now, Ankara has instead touted an alternative deal, or at least development project, called the Iraq Development Road Initiative. Now, this road would cost $17 billion, taking goods from the Granfar port in southern Iraq through 10 Iraqi provinces and into Turkey. This would have 3 phases, with the first aiming for completion in 2028 and the last in 2050. So if you're trying to look at this in terms of short term versus long term, a lot of the US kind of policy around diverting away from China could be argued is more of a short-term solution. The USA is having current troubles with China in relation to their foreign policy, especially around Taiwan, and so that they want to establish this sort of trade development project to divert trade away from China. Yet there's no real point in embarking on this project if they're only going to be able to fully enjoy its use by 2050. And we also know that a lot of these projects do end up becoming delayed, they cost more money, and so you could be looking at 2060 before this is completed. And so when you're looking at the USA's cost benefit analysis, is it really worth it for them to back this sort of thing along with the EU when a shorter alternative is there? Now, the feasibility of this project is also questionable, considering issues with financial and security concerns. This is, not a surprise to anyone really, with Iraq suffering, some of the greatest horrors of war over the last 20 years, whether that be Saddam Hussein and, the US invasion into Iraq, or, the issues with ISIS, rebel groups, Iran, as well as the Kurds now in the north, which could disrupt this sort of this chain, this route, which would directly run through Kurdish territories. Now, with Turkey, as well as that, also lacks much of the funding, and Iraq's issues around security and liability and stability, are also threatening the project, because we can't imagine Iraq to have the finances to fund this as well. So it seems unlikely that this will be an actual project embarked on. But moving on from that, We also have public confidence in the Bank of England to talk about, with 40% of Britons in August saying they were dissatisfied with how the central bank was doing in the project of controlling the pace of inflation. Now, the very low number of 19% of people were actually satisfied with the Bank of England's performance, with a net satisfaction down 13% from last May, and the lowest reading since the records began in 1999. Now, that's obviously not good at all, and a lot of this is, sorry, that's going back to the last one to talk about. But this obviously can't be positive for the UK economy nor the Bank of England, and this adds to the expectation of 0.25% percentage point increase in the interest rates this Thursday, and we'll come to that at the end. But the Bank of England does have its interest rate decision this Thursday, so it'll be interesting to see how this will kind of play into effect, because the Bank of England will be seeing that even more consumers are worried about rising inflation, or at least sticky inflation, and so it'll be about how the Bank of England can try and combat that, and possibly by raising rates once more by 0.25, and this would be making rates the highest for 15 years. Now, UK inflation is 3 times the Bank of England target, sitting at 6.8% despite being down from the peak of 11.1% last October. So although it's coming down, this is still very high, and higher, I believe, than most G7 economies, and so it's really the job of the Bank of England here to try and combat it. But obviously, we understand that this is a global issue as well, with many central banks struggling greatly with dealing with this issue. There are disputes within the Bank of England as well on whether to raise rates, as we spoke about last week, with the more hawkish Bank of England policymakers, kind of discouraging this sort of attitude of raising rates not discouraging, but encouraging this behaviour of raising rates further, whilst, the actual leader of the Bank of England, Andrew Bailey, kind of discouraging that sort of behaviour and saying that rates are at their highest already. Now, higher fuel costs as well are also adding to the risks of inflation, which is expected to tick up to 7% in August, and that's higher than previously expected. High inflation expectations have also increased the risk of inflation becoming embedded in prices and wage setting, because obviously we know that trade unions, and any employer or employee wants their wages to match inflation, and so when employees go to and demand for a higher wage in relation to inflation, this kind of causes a wage spiral, or an inflation spiral, where, because you're increasing the wages as a result of expected inflation, this drives inflation higher, because to cover the costs of increasing labour costs, they raise prices, and that's causing the inflation. So it'll be interesting to see how this will play out, and how the Bank of England can really respond to this in a good manner. Now, according to new data as well, service industries explain the greatest increase in prices as a result of wage rises, whilst in manufacturing, higher energy costs and supply chain disruptions argue to be the greatest cause of inflation. And we'll come to that in a second, but this seems to be the consensus across many countries, that these service sector jobs are costing the most money in terms of wage increases, whereas these manufacturing sectors aren't seeing as many issues with increasing wage demands, but rather the higher energy costs. And that's to be expected with manufacturing, obviously using more energy. But next to talk about, we'll come to pound at the end on the charts, but the next article to talk about is the ECB, which has warned of a December rate rise, if inflation and wages stay hot. So staying around the same sort of topic really, but now going to the Eurozone. At the last ECB meeting, it seemed clear that rates were going to come down soon, or at least stay the same. We spoke about that last week with the response of the ECB being that, we're nearing the end of our rate hiking cycle and rates will come down next year, basically. However, 7 hawkish rate setters believe that rates could rise in December if wages keep increasing and inflation proves stickier. And this is sort of, a real issue for, Germany and the Eurozone, because this is stagflation kicking in, really, with, the German economy especially, nearing recession levels, and, the Eurozone declining over, or well, not declining, but, having very weak growth, with inflation staying sticky. This causes the issue of stagflation, so it'll be interesting to see how the ECB can respond to this in the correct manner. Now, most investors see the last rate rise to be the last, but 3 people in the monetary policy, within the monetary policy meeting, told that Financial Times, that the door was still open to raising rates should inflation rise. Following the last meeting, investors expected the move to be rate cuts in. Investors expected the next move to be rate cuts, which would take place in the first part of next year. So the first half of next year, and we kind of saw this reaction last week, where we were looking at the euro and we actually saw that the euro went down despite raising rates, and this would be contradictory to what most people would expect, because you think if there's a higher rate, more people are going to put their money into it, so the value of the currency would go up. But this was the opposite, and this was because people and investors understood that rates were going to have to come down soon, largely because of these economic woes within the economies in relation to growth and manufacturing decline. However, that said, the ECB President Lagarde said cuts had not yet been discussed. So although all these investors were kind of predicting rate cuts, she never really said anything about it. So it's hard to actually go off any truth in relation to this. And once again, high wage growth has raised concerns over continuing inflation. So this does seem to be a consensus across most economies, and a concerning issue for most. With services in the Eurozone encountering similar issues to the UK, with rising wages by 5.5% driving inflation higher. So just as the UK is experiencing wage growth causing inflation, so is the Eurozone. And rising rates have also caused new political issues within Italy, where Prime Minister Giorgia Meloni's government has repeatedly protested against the ECB's strategy in relation to inflation, with some investors also questioning why rates were increased considering the deteriorating outlook for the Eurozone economy. So it'll be interesting to see how the ECB can really deal with this issue, with increasing political issues in relation to possible rate hikes, and the issue of having high inflation, but also having high rates, so the rates aren't even doing much to bring down inflation, and what you can actually do about that. But the last article to speak about is about China, which we'll bring up in a second. But basically, Chinese economic activity data signals optimism after stimulus measures, and we spoke about maybe 2 weeks ago the new stimulus measures that the Chinese government had introduced, and how that sort of hadn't had much of an effect on the Chinese economy. But this kind of shows different data. Now, China's retail sales and industrial production grew faster than expected in August, following policymakers stepping up stimulus measures. Data also showed, however, that home prices in big cities edged lower after investor concerns about developer defaults. And also 2 weeks ago, in relation to this, we were speaking about a lot of the issues to do with developers, almost borrowing too much and not being able to pay that back. And as we know, a lot of the Chinese consumers are invested into the property market. That is the leading, investment. And so it'll be interesting to see how this will actually play out with, there is some positive data, obviously, with China, but overall there's still large issues within the property sector, which China's so heavily invested in. And industrial production rose 4.5%, far above the 3.7% of July, and retail sales added 4.6%, also being far higher than the 2.5% of July. So it is the case that, industrial production is rising once again, and retail sales are rising significantly once again. But this is still, below targets, and ultimately it doesn't outweigh the larger issues surrounding and structural issues surrounding the Chinese economy. Fixed rate asset investments, on the other hand, only rose 3.2% in the first 8 months of the year, and that's compared with the 3.4% rise to the end of July. So, these investments are falling. Property investment is also down 8.8% from January to August, and obviously we understand that that's a large sector for China. And all this data caused the CSI 300 to close 0.7% down by the end of last week, and we know that that's the leading index for China. Policymakers recently have revealed a series of stimulus measures in order to boost growth, such as cutting the reserve requirement ratio for banks by 0.25%, as well as other interest rate cuts or cuts on price restrictions for properties. But it's how much this can actually have effect, because prior to this data, we haven't actually seen much to show that these policies are actually having a great enough effect. In fact, they may be too little, too late. And consumer prices in China turned negative in July before edging back into positive territory in August, while exports and imports declined less sharply in July last month by 8.8% and 7.3% respectively. So the data's kind of mixed, really, following what came out on Friday. But it'd be interesting to see how markets will respond to this this week, especially within the Chinese property sector, as well as their fixed income assets. But we'll come to the charts now, and we're done with the articles. So let's get straight to it. The main things to talk about, though, really is that US indices have fallen off a cliff. Dollar makes new highs. Euro reaches new liquidity. Possibly a move higher is coming. And there's also downside potential in USD JPY, with gold bouncing higher and Brent crude oil grabbing liquidity. But let's just wait for this to pull up. So yes, here we've got US indices to talk about. So yeah, to talk about first, we've got the Dow Jones. Now, the Dow Jones we've been speaking about quite a lot, and it's kind of been consolidating around these areas. It pushed up, it retraced down, but it was starting to consolidate. But following the US buyback news around companies reducing their buybacks on their own stocks, we've seen this kind of decline in the price of the US 30, with it falling back down to this kind of liquidity area around the 34575 area. So it'll be interesting to see whether it will once again use this area of liquidity before moving higher, or in fact it will continue lower with this negative news around US share buybacks coming out with the possible regulations which may be introduced, which reduce the amount of buybacks taking place within the US market. And we've kind of seen this reflected across all the US indices. There's kind of been this decline, and it's kind of created certain opportunities, especially on the NASDAQ, because as we can see here, I've drawn out the Fibonacci retracement tool here, and along with that, I've placed a liquidity area just below the lowest low of this session, or of this kind of week. Of last week, by the end of last week, this was the lowest low, made before it kind of moved higher. And as we can see there, there's some strong areas of liquidity just below that area, because that's where prices moved up from before. So we know that orders are likely to be around that area. And along with that, we have the 50% Fibonacci mark. So it'll be interesting to see whether the US 100 will actually use this area for a move higher, or in fact it will break lower and continue lower as a result of the the economic data, well, not the economic data, but the news surrounding share buybacks. And once again, this is reflected across most assets, US assets, and as we can see here, once again, a decline in the S&P 500 and it closing lower. So let's see whether this week will make some gains on US indices, or they will in fact move lower still. But the next to talk about is the dollar. Sorry. But yeah, I guess we can talk about the US indices for a bit longer here. But yeah, the US 500 obviously is starting to move back down to this area around the 50% Fibonacci mark, and we also understand that the Fibonacci won't always be super consistent around whether markets will actually move from that area, and it's largely based on what's the economic data saying, and what's the financial news around it saying. And so it's also important to take that into account. So we can't just go off the fact that it's reaching around this 50% area, and so it's it's a perfect buy. That said, we have to look at the long-term picture of the US 500 and of US indices. How much is this US buybacks, or how much is the buybacks of US indices really going to affect the long-term picture of US indices? And that's a question to be asked, really, is will it actually have that much of effect? If it doesn't, then it could actually continue to move higher, and this could just be a short retracement. Whereas if this actually is some long-term and structural issue for the economy, especially if new regulations are coming in around US share buybacks, then we can understand that US indices might not ever respond correctly to this issue. Sorry, I'm just having some issues with my chart software.